Hello, my name is Renee Michael, and I'm a partner with Sweeney and Michael Financial Planning and Investment Management. I want to take a moment and thank you for joining in for a quick webinar on the basics of money and investing. This might be a refresher for you or your starting guide to financial freedom. It's always important to know the objective before we begin. So, what we hope to do today is help anyone get smarter about money in 20 minutes or less. The finance world has a lingo all of its own, and it can sometimes be uncomfortable to ask questions. We hope to answer some common questions today and provide our team's contact information if you would like to have a deeper discussion. Our team is pictured here. Joe is on the far left. I'm next to him. Carla, our office manager, and then Katie, who is also an advisor. You can reach out to any of us using the information below. We'll start with banking. Banking may seem like a non-important topic. However, if you're a student, young, retiring, moving, having a bank that is easily accessible is very important. A few things to consider or think about when choosing a bank is your bank national or international, especially if you like to travel? What are the fees to open an account, maintain the account, and are there any minimums required for the account? If you use bill or cash apps, or bill pay or cash apps like Venmo and Apple Pay, make sure these are part of the bank's platforms. Unless you are taking money out of an ATM, always choose credit instead of debit. In case of fraud, your purchases and funds are better protected when your cards are used as credit. Saving. Saving money is something that most people struggle to do. Recent studies have shown that 40% of Americans don't have enough money to cover a $400 emergency, and only 39% have enough money for a $1,000 emergency. Saving is more important than investing. If you don't have any money saved, then you have no money to invest. Saving, like everything good for us in life, comes down to discipline and consistency. Today, shopping has never been easier. It's right at your fingertips and one click away. I think it is fabulous in so many ways, except in regards to opportunity cost. Opportunity cost refers to the value of what you have to give up in order to choose something else. In a nutshell, it's a value of the road not taken. For an example, new shoes versus $150 into your savings or 401k. Start early so your money has time to compound. Sooner you start, the less you have to save to reach your goals. Saving doesn't just happen. One of the best strategies to save money is to make the process automatic. When you automate your savings, you're more likely to make saving a consistent priority and can watch your money grow. If your company offers a retirement plan, use it. It's the most easiest and most efficient way to save automatically and consistently. Here are the 6 P's. And I heard this at a conference over a decade ago, and I still write it in my day planner every year as a reminder. Proper planning prevents piss poor performance. In other words, good planning creates good habits, and these lead to a good life. My favorite thing is planning, but it is many people's least favorite. A few quick tips if you're just starting out. Don't start out the month in red. Your rent should not be more than 40% of your monthly income. And if you have a mortgage payment, that should never be more than 30% of your monthly income. The hardest thing for most of us to do is wait until you can afford it. I tend to set financial and personal goals each year, both short-term and long-term. It definitely helps. You do want to treat yourself, but be realistic in those treats. As we earn more income, we tend to fall into lifestyle creep, which means It never seems like we get ahead because we adjust our spending with our income. Lastly, be patient with yourself and make sure you have a good credit score. This is very important. So, these are the things I've learned that help me manage my money much better than I ever did in my 20s or even most of my 30s. Know what you owe and when it's due. Write all your bills and expenses down. Schedule bills to coincide with your pay schedule. And then calculate your free cash flow, what you have left after you pay yourself and your bills. This is an example of how I personally manage and organize my bills. I still do it with a notebook, one page for each month. I highlight the expenses that I've paid and the bills that I've paid. I add new bills when they come in. Now, everyone organizes differently, but I thought I'd share what has worked for me. So, what is debt? There's bad and there's good. Debt is borrowing money you don't have to pay for something you otherwise couldn't afford. So there's good debt and bad debt. Bad is anything you don't pay off each month. Credit cards, personal loans, a car that's unaffordable for your salary. There's also good debt, which includes things with high utility that can appreciate in value. A home, an education, and an affordable car. So how much is too much? Calculate your debt to income ratio. You take total bad debt and divide it by your annual income. Your target number is 20%. Ideally, we want that at 0. Know your credit score. I mentioned it's very important. Your credit score can range from 300 to 850. You can check out myfico.com for calculators. It will help you figure out how much you can afford based on your credit and your salary. I've listed the 3 companies that do credit scores and have credit reports. You can go independently to each of them and run your report, or once a year. I often do this at the first of the year. I go to www.annualcreditreport.com. You can log in and you can see all 3 of your credit reports. It's very good to review them and make sure there's nothing on there that shouldn't be. Now to investing. So investing is putting your money to work for you. Investing is not gambling or get-rich-quick schemes. It should not feel like a game of chance. That is trading. Investing is setting a goal, short or long term, and creating a strategy that combines the amount you can afford to invest per year and your appetite for risk. There's 2 common ways to invest. But first, how does an idea become an investment opportunity? Do you want to be an owner or a loaner? That's the big question. Let's take Apple. Apple wanted to expand and needed to raise capital, money. They had 2 options: offer shares of their company in stock, or ask for loans from banks, or issue bonds, which is a loan, to individuals and corporations. Stocks, also called equities, are ownership shares of a company. So if you chose to buy Apple shares in the prior example, you would have ownership in the company. Owning stocks can help you increase your wealth through growth, capital appreciation, and income, also referred to as dividends. Stocks also act as an inflation hedge, as companies have the ability to pass through their increasing cost to their consumers. However, stock prices can be volatile at times, and in the worst situations, can lose their entire value. If you chose to be a loaner to Apple, you are owed back your initial investment plus interest. So you're a bondholder. Corporations, governments, and organizations can all issue bonds. When you are buying a bond, you can assess the company or government's ability to repay the loan based on the grade given by an independent organization. Ideally, you want to buy investment grade bonds, which means they're more likely to be able to repay the bond. And those would be rated between AAA to BBB negative. Bonds can be a great source of income as bonds are issued with a promised interest rate. Generally, they're less volatile than stocks, but geopolitical disruptions affect all sectors of the markets. We saw that with COVID and when Russia invaded Ukraine. Bonds are also sensitive to interest rate hikes and are vulnerable to inflation risk. So, what should your investment strategy look like? Here is a great visual to see how different asset allocations, which is the mix of stocks and bonds you own, have performed over the last 93 years. The circles at the top show the percentages of bonds, which is the top number, and stocks, the bottom number. Directly below each circle, there is a bar on the chart that shows the best annual return for that allocation, the worst annual return, and the average annual return for those 93 years. As you can see, the more stocks you own, the more volatile your account will be in the short term. However, if you look at the long-term averages, higher risk equals higher reward. This doesn't mean pick the biggest winner. We show you this to better understand the price fluctuations that could happen in each allocation. Your portfolio should reflect your risk appetite, age, amount you already have invested, and how much you're able to contribute each year. Mutual funds are the most common investment vehicle available in retirement plans. They allow you to pool your money together with other investors to purchase a grocery basket of stocks, bonds, or both, which is called a portfolio. The price of a mutual fund is determined by the value of all of the holdings at the close of each market day. By pooling your funds together with other investors, you have a bigger pool of money and can take advantage of immediate diversification. Mutual fund prices fluctuate based on the value of the underlying securities day to day. There are really two strategies, basic strategies, fundamental strategies for mutual fund management. Would be active versus passive. Actively managed funds employ teams of managers and research analysts to pick the individual stocks and bonds. Because they have more employees and more overhead, managed funds tend to have a higher cost. This is often referred to as expense ratio. Passive funds do not have staff or researchers like those of the active funds. These are set up to mirror an index. The most common, the S&P 500 index. You can buy Vanguard 500, Fidelity 500, iShares 500. You can buy a fund that mirrors the index, has no professional management, and changes as the index changes. Because there is little to no management, these options do tend to have a lower cost. Now to risk. We mentioned risk a little bit, but for investments, there's three common types of risk: market risk, losing money as a result of market fluctuations, and this risk becomes more important as you get closer to retirement. Longevity risk is the risk of outliving your money. We are all living much longer today than our grandparents and great-grandparents. And inflation risk is one we're all aware of right now. In investing, inflation risk is that you may not earn enough to keep pace or outpace inflation. Risk can't be deleted when it comes to investing unless you want to put a lot of money in with low returns. Most successful people and wealthy people do take risks. They do their research, they do not invest all their funds into speculative investments, and they are consistent. Warren Buffett, one of the most renowned investors of our time, says time is the most important aspect of investing. Due to the magic of compounding, even though he had a net worth of 1 million at 30, he made 90% of his wealth after age 65. It's called the compound effect. And how it works is the money you save, either in a savings account, mutual funds, individual stocks, bonds, these all earn interest, pay dividends, or can appreciate in value. When you earn that interest on the money you save, plus the interest you've accumulated, your savings grow and you earn interest on a bigger and bigger pool of money. A great visual to think about is a snowball. Let's look at two scenarios of saving. First is lump sum investing. Let's assume you put $2,000 in an investment at age 25. You averaged an 8% return each year. 40 years later, at age 65, you'd have over 50,000. At age 70, you'd have over 77,000. The second is to consistently invest. Imagine instead of investing $2,000 one time, you invest $2,000 each year, or about $165 a month. With the same average annual return, at age 65, you would have over 630,000 and over 950,000 at age 70. Consistency and time make a big difference. It's hard to contemplate retirement at 25, 35, or even 45, and getting started is hard. However, for the lucky of us, we will get to that point, and it is our responsibility to plan and save. The reason for saving and investing during your working years is so you can replace your paycheck once retired. How you live in retirement is up to you. Thank you for listening in and sharing. I hope you found a few things helpful. Should you have any questions, please email or call any of us in the office. We're here to answer all of your questions. Have a fabulous day.